We're going to jump in. I'm super excited for this topic tonight. Before I introduce our guests, I just want to say something about this topic. A lot of people are really concerned about what to invest in. And they're seeing a lot of times, even for me, with some of the multifamily stuff that I've invested in that was producing a lot of cash flow, the cash flow has slowed down due to interest costs or other reasons like that. So we found some of these alternative deals, such as oil and gas, such as ATMs, other sorts of real estate deals, or things that are a little bit alternative, can be really, really attractive. So we're going to have a conversation around some different assets. We're going to do some Q&A at the end. We're also going to spend some time talking about economics, talking about what the Fed is doing. We're going to give some different opinions. These are three good friends of mine that are here that really are experts as well in the space of alternative investing. So I know you're going to love it. You're going to really enjoy it. So, and actually, I had a rumor it's Patrick Grimes' birthday tomorrow. Is that right? Awesome. And I think you're muted there, but you're turning 21, right? Is that you're the Benjamin Button case?
20th annual.
20th annual.
Yeah. On St. Patty's Day.
Awesome. Awesome, man.
Well, presents. It's on your calendars now. You can't forget that.
Well, we'll have to give you a virtual pie in the face before the night is up here and wish you a happy birthday. Well, let's go ahead and welcome Patrick from Invest on Main Street. Welcome, Patrick. We're going to get into kind of what you do. Dave Zook, we've worked on some deals together, the real asset investor. Welcome, Dave. We just saw each other at the best ever, as well as Patrick was there as well. And then Denis Shapiro, who runs the SIH Capital Group and is the author of the Alternative Investing Almanac. Is that the correct name?
Yeah, the Alternative Investment Almanac. It's close enough.
Awesome. Awesome. Well, so great to have you guys. Really excited to jump in here. We're gonna have a great conversation. If you do, in our audience, if you do have some questions, you can stick them in the chat. We are gonna do a time for Q&A at the end, and there actually a chat. There's also a Q&A area. So if you stick it in the Q&A area, we'll see it. We probably won't get to some of the questions until further along in the program, but really excited to go over it today. So let's just kind of jump in and let's talk about, I want to kind of start with a little more of a general question, but what really is the case right now for alternative investments beyond things like stocks, bonds, or even multifamily? Like what are some reasons why maybe you as an operator decided to look outside of some of the traditional kind of ways, even when people think about real estate? Maybe we can start with Denis on this one.
Yeah, so I'll throw two that I have off the top of my head. The first one is lack of liquidity. When the market is this volatile, it's really good to have a portion of your portfolio that is not moving as volatile as the stocks and bonds. So a lot of times you come across investors and they're like, well, I do invest in real estate, I do REITs. Well, if you look at what happens to REITs on a down day, if the market's down 1 or 2% because of algorithms, usually a REIT is going to be down almost 95% of that 1 to 2%. So you're not really getting that diversification that you would if you did invest in private real estate. So I would say that's the number one reason. And then a close second is that alternative investments, they allow you to take advantage of your network and building those relationships. Versus if you're in the public space, if you build a relationship with the CEO, and then you might actually go to jail for insider trading. Versus in the alternative space, you could build a relationship with Patrick, with Dave, and all of a sudden now you have an extra layer of information before investing in oil and gas or affordable housing or ATM machines. So that ability to leverage your relationships and your network, I think, and the fact that it's a lack of liquidity are the two main, I think, pros to investing in alternative investments in today's atmosphere.
That's great. Yeah, those are great reasons for sure. Being illiquid, a lot of people think as a negative, but it actually has a lot of positives because it helps you ride out some of these volatile times. Dave Zook, what do you think? What are some reasons for people to look beyond traditional investing or even only multifamily type of alternative investing? What are some things you look at?
Yeah, well, we could probably have a whole webinar just based on that question, but I've got three. I've got control. When you're running a let's say a car wash business, you got control. You can make decisions and kind of control your own destiny there. Predictability. When you've got a really good product and you do a really good job and you go out in the market and you're serving people, you get a pretty, assuming you got a viable asset class, you're going to have a pretty predictable outcome. The better you serve your customer, the better that asset's going to perform, and you can control the outcome, and it's predictable. And then a really important one for me, and this is near and dear to my heart, is tax efficiency. You know, when you go out and invest in let's just go on as a multifamily apartment REIT, you don't get to take the depreciation and use it to wipe out the tax liability on your other income like you do when you go out and invest in the asset in a, you know, in a deal with Patrick or Dennis. You know, you don't get that tax efficiency. And so that's a big one. Many investors, you know, may not take, you know, many investors who invest in the stock market only, they don't get that tax efficiency like we do and that we're so fond of, because many times that may be your biggest first year return is when you wipe out a big chunk of your tax liability. So tax efficiency is a big one for me too.
Yeah, we're going to talk a lot more about tax efficiency, and just, you know, that's one of the reasons why, you know, we love alternative investing, especially real estate, is because of some of the tax benefits, and there's other tax benefits and other alternative assets as well. Patrick, what are some reasons you think, especially right now, is a good time to look in alternative assets?
Well, first I want to say there's a lot of really great people. I'm happy to be here. I've even got Denis Shapiro's book I brought with me. I'm hoping he can sign it for me before so don't leave without doing yeah. Good. A lot of really good comments. I can't disagree with anything that was just said. If you read my passive investor guide, it says that the middle class actually only diversifies about 8% of their wealth into these alternative investments. High income earners are closer to 25 and the ultra wealthy 50. And I mean, I like many of you and the people that were watching, I used to be a high income earner in corporate America, and I saw my stock portfolio go up and down, and I invested heavily in real estate in 2008, and I lost all of it, 9 and 10. I saw the bust. So I like to say that in alternative assets, and if you look at the middle class, ultra wealthy, they're invested in more than just one alternative asset. And those are assets that don't rise and fall with the stock market, right? Those are ones that have different market fundamentals that allow for them to have insulation or shielding from things like inflation, things like interest rates, right? That provide for tax advantages. And so I always am looking for these alternative investments that can not necessarily just diversify into a lot of different kinds of real estate, which we've seen can correlate in a similar way that the stock market, a sentiment-driven thing, can correlate, right? But looking for things like energy. Energy is another essential need, like housing and food, right? We need it even in recessions. In fact, it's probably the most tax advantaged. And some of these guys on this phone here have those. I think most of us do have those investments, but even better tax advantages in real estate. But we don't use debt. They're shielded from interest rate. And natural gas and oil actually hedges with inflation. It's one of the strongest indicators of inflation. So you can win with inflation, an inflationary environment. And in a year like this year, when real estate's in a correction and stock market's down, it's an asset where you can hang your hat and you can win. And that's the true goal, right? It's diversification of your portfolio through breaking it up into non-correlated investments. And that's done through alternative assets.
That's really well said, man. We have an ebook we wrote on our website at Bronson Equity. It's how to use inflation to your advantage. And you touched on that of, you know, rather than being pained by inflation, it actually helps you, right? It actually allows you to not only weather it, but actually grow your wealth during a time of inflation. We're going to get into specific asset classes here in a minute, but I wanted to take some time. There are some people, you know, obviously the Silicon Valley Bank thing is very recent. We're seeing, you know, just different financial stuff happening right now. I think it's important that we talk about it. I wanted to see kind of what opinions are out there as far as, you know, is this simply the Fed raising rates? I mean, I have some opinions on what happened at Silicon Valley Bank, but as far as the financial system, does this mean the Fed is going to then, you know, hold rates where they are, and then they're going to be able to start lowering them again, and that will change, you know, how we borrow for alternative assets, such as multifamily or other assets? Let's start with Denis on this one.
So this is an interesting question because it's one of the I guess the big benefits of alternative assets is because you could literally invest and then never really follow along in what's happening because you have an operator there and he is, you know, managing the business. He or she is managing the business plan to execution. However, when you get into the traditional side, you kind of get into the habit of, hey, let me go pull up my portfolio and see what's going on. So last couple of weeks, if you follow the news trend, it's literally every single data point is changing whether or not the Fed is raising, holding, increasing the raise, everything. And it's just so funny how you would look at something and say, oh, that cannot be good for the market. And all of a sudden you see the market's up 2%. It's completely illogical that a mid-major bank is actually collapsing, and the market is like, well, this prices the potential increase in half. So this is actually really good news for everybody. So, you know, it's just interesting. You really, when it comes to the traditional side, you really don't know what's going to happen. You could only assume, and it usually is a 180 of what you can expect. Versus a little bit, I just tied into the alternative space. It's a little bit more logical. You know, if you increase the net NOI of something, the underlying asset's actually going to increase in value. So it's kind of interesting because it's a lot of noise right now. It's, you know, maybe in 2 months, no one is even going to remember what SVP is. And just like, can we talk about 10 years ago, Washington Mutual? And, you know, I remember I used to bank there. And it becomes an afterthought, but what's going to be here in 10 years is, you know, the gases, the ATM machines, the multifamily, the hard assets, so to say.
Yeah, you brought up something too, that with the Fed, a lot of times, you know, they give these forecasts and then they just immediately pivot. You know, I mean, they did this whole thing, oh, rates are good, we have low rates. All of a sudden, they're just like very quickly they turn. So I don't care what guidance they say, they're going to stay committed to that until they decide to turn. Dave, Zook, what are some of your thoughts on what's happening right now, some of the financial issues that are happening, or even with the Fed? Do you have some opinions on that you can share?
Yeah, so you know, I mean, in its pure and simple form, is a bailout. You know, they say, oh no, the taxpayers aren't going to pay for this, and you know, it was a bailout. And you know, Dennis, you shared that, you know, what happened in you know, Washington Mutual, it's an afterthought, and you know, what a lot of these depositors at SVB, you know, in 2 months it'll be an afterthought to them. But I guarantee you, if that bank wouldn't have got, you know, if those depositors wouldn't have got bailed out, and that bank would have had to go through its natural course of what, you know, of what you think about when you think in terms of capitalism. It would not be an afterthought to many of these depositors that would have lost, you know, anybody that was, you know, anybody that had deposits in there over $250,000, you know. So I really heard, or I saw people, you know, really cheering about, oh wow, you know, the Feds did the right thing, they stepped in and they, you know, they made sure, you know, I mean, it was there for a little while. You know, on Saturday and Sunday you didn't know what was going to happen, what Monday was going to be like, you know, and so they stepped in and they just made it okay and wiped out, you know, that bank's mistakes, SVB's mistakes. That was good for the short term. What does it look like for the long term? You know, and now you just let everybody in this country know that no, you don't need to be careful, and you don't, you know, you can do what, and you left the big banks know, you can do whatever you want. You're not accountable for your actions. You know, I just, look, I'm a capitalist, and you know, what happened there was a giant bailout, and you know, maybe it was good for the short term, but I'm not liking it for the long term.
Yeah, they kind of basically said they're backing up all depositors regardless of any, you know, if FDIC was typically up to 250,000. I think 90% of the deposits were above 250,000 at Silicon Valley Bank. And maybe there's reasons, you know, there's reasons why, and they're considering all the businesses and things. But when you don't let things take their natural course, oh, did I freeze for a minute?
You're back.
I'm back. Okay. Yes.
Right.
So I guess my internet connection is unstable. So hopefully I'll be more stable. But anyway, the you know, the government coming in to back everything up, it gives the impression that, you know, there's a moral hazard there, that banks can kind of act however they want, and you know, they can be an idiot, and the taxpayer and everybody else is responsible. Patrick, what do you think? What are some thoughts on kind of what's happening, and even the Fed, and just kind of where we're at currently?
Well, I hate to just kind of repeat a lot of what I just heard, but I couldn't agree more. Unfortunately, it's a bailout, and the funds that they used to do it, maybe they were able to pony up this time, but they don't have the trillions required to be able to not just bail out this bank, but all the other banks. And so it's going to be very difficult for them to pivot in a way where they don't cause that issue of the cascading dominoes of numerous other banks beginning to make much more risky products, which it's a competitive world. And the banks are going to do their best to put the most competitive products out there, the most attractive products. And it's got to be regulated that sometimes somebody loses for being too aggressive. And unfortunately, they're saying that's not the case. So we'll see what happens. At the same time, they're looking at some bigger picture items. We're struggling with inflation right now, and we got a temporary relief on interest rate rises, and a lot of people are kind of coming up for air. I mean, it seems like we're doing okay. We're distributing on most of our properties as planned, but I mean, we see a lot of properties right now that I'm getting calls about that aren't, and they didn't control interest rates, get fixed interest rates. So at the same time, I think that there's some relief to potentially these rate hikes, which are needed because there are businesses and there are banks that are going to struggle, and maybe it gives them some time to pivot. So I think potentially their move to give a reprieve on interest rate climbing for a period of time here is a good thing. Lets people reset because it's been pretty aggressive for a while. At the same time, I don't think it's going to end. I think they're going to continue to raise rates until they get inflation under control. And that's really the one knob that they have. They really don't have much other knobs for that, which fortunately for most of our alternative investments, it fares well for us. I mean, I think we tend to do better in down economies, right? We tend to shine. And so I think we're going to do pretty solid, but as a country as a whole, it's not a good thing. I mean, we all went through 2008-9. And we had hoped that they fixed a lot of those issues. Well, doesn't look like all of them.
Yeah, obviously not. Yeah, and you mentioned, something about, rate hikes, and we heard Danielle DiMartino Booth at an investor summit in Belize last year, and she was saying that the Fed will continue to increase rates until something breaks. And the something breaks, could be in the credit markets, or this could be, the first sign, Silicon Valley Bank. But basically, regardless of whether, the rates stay high or not, we are seeing, not in deals that we're currently in at Bronson Equity, but we're seeing it. We're hearing rumblings of it, that there are some multifamily or other deals that are in distress. Have you guys heard, or are you guys involved with, types? And I know you guys, you have other debt funds that you do, but there's kind of this idea that, there's an opportunity here to raise a fund or a debt fund to come in and kind of be like a white knight, come in and help provide liquidity if people can't make payments, or maybe they can't refinance or things like, because a lot of people have bridge debt that's shorter term. Are you hearing about funds like that? Are you considering doing a fund like that? Anybody can jump in if they're involved in something like that or they're familiar.
I can take that. Oh, sorry. Well, I was going to say, so I think it's important with this question to actually kind of figure out why these multifamily operators are actually in distress. And what ended up happening, from what I gather, is that the people who were getting floating rate debt, which is the majority, usually it's the people who are in fixed debt and are good operators. They are not the ones that are stopping distributions or doing capital calls or anything like that. It's the operators out there who got floating rate debt and then assumed that their floating rate cap would stay on for the life of their deal. And what they didn't realize is, what I think they overlooked, and in hindsight, obviously it's easy to say, is that insurance gets tapped out and then you got to renew that insurance. So now what ends up happening is they purchased that insurance for $20,000 last year. They're going today, because the cap is all used up, to buy additional insurance. And that insurance is 10x, 20x. So what ends up happening is, if they have the reserves, they can pay it easily. However, but then they're probably going to stop distributions just to retap those reserves. But if they don't, now you're seeing capital calls. And it's interesting because pre let's say, January 2023, like capital call was a sin, right? If you do that as a capital raiser, as an operator, you're losing a lot of your investor base. It's so ironic that now we're in a situation where so many people are going to go through a capital call or a stop distributions or just many other bad things, where in 6 months, 9 months, it's no longer going to be a cardinal sin. It's almost going to be like, if you're an investor in 10 to 20 deals, you've probably had a capital call, or you've had, multiple distributions paused. So I think it's an interesting market. I think this is the time where investors really need to focus on the relationships. Operators really need to focus on operating. And yes, it is an opportune time. We are constantly talking, we're constantly following deals that are in distress. But we also want to be careful. There's also, besides a financial reason, there's also an operational reason why some of these deals are in distress. Because if you have a really experienced operator, they might have paused distributions, but they're not in capital call foreclosure distress. However, if they are, financially misplayed the interest rates and they operationally are in trouble, that is not necessarily a deal that you just want to go in there and say, oh, there's blood on the street, I'm going to buy this deal and become a millionaire overnight. So, it is something that we are watching, but we are very cautious. We are leveraging our network to find the full story of why that asset is in such distress. A lot of times, even though it's in distress, it's being priced appropriately. So, for example, they want $5 million for an asset. If you put $1.5 million for it, it's going to be worth 6.5, 7. So to me, that's not really distress, because you're going to be doing a lot of work to make, a nominal amount of equity. So I think all those things are important. At SIH Capital Group, we do have an income fund. We are just shifting to more assets that are actually collateralized. That's basically our philosophy during this process. We had the income fund before all of this. So it's not like we're like, oh, this is a great time, I'm just going to launch to take advantage of this. But we are shifting the philosophy in that fund a little bit as the times kind of change.
That's a great summary, Dennis. Really appreciate that. I think, we're seeing in our deals, we had no capital calls, thankfully, knock on wood, but we're seeing with that, just the raise, we have caps on all of our interest rates. A lot of about 85 to 90% of multifamily debt is bridge debt. And so we have these caps there. So going from 4.5% up to 6.5%, that does eat into your cash. And so that is a consideration. Patrick, what are your thoughts on this? I know you're multifamily as well as other things. Have you heard about these type of debt funds to take advantage of distressed operators or things like this, or is this something you considered as well?
Well, so most of I think the good multifamily deals, like Dennis was saying, right now, what they're going to be is a combination of bad days have happened. Like the most recent deal in Atlanta, the guy had a 14% bad debt going through COVID, struggled managing through COVID. Then a building burned down. He didn't have the money to renovate units. They're still, 300 to 400 below. And he just took off with the insurance money. So we swooped in there and bought it real quick. So we got a discount, right? To Dennis's point, you can't buy at market. You got to buy at a discount. You got to buy with lift. And that allows you to win even in a down market. And those are the kind of, I would call it a combination of opportunistic. The guy was like, hey, instead of rebuilding this building, he could just move away with this insurance money. We can move in and do the work to lift it. And so I'd say it's not necessarily just opportunistic is what I like to call it, because sometimes it's just that they're distressed. Sometimes you just have the opportunity to jump in and find a really good deal that's at a discount. But the other part that's not really being talked about right now that I actually was going to point at was a lot of the reasons why these properties are distressed is because the delinquencies are extremely high right now. And people have gone through COVID and they've sometimes lost their jobs. Some have gone back to work. Some have gotten renter assistantship this entire time, but then it ran out. And then they had supplement programs and then those ran out. And so now you finally have these huge waves going through many of the markets where they're seeing massive delinquencies. People that haven't been paying for years aren't getting back to work, aren't paying. And then the courts are flooded with evictions. And so I've been getting a lot of reports of, look, interest rates are consuming all the income we have because they're rising, not to our cap yet. And our income's going way down. So that's really the breaking point, is when that break even, that shift happens, and then can they survive it? Do they have the reserves? But I think what people aren't talking about is, well, where are those people going? And so instead of coming up with an opportunistic fund where we're like, hey, look, let's raise a bunch of capital to find distressed operators, we're launching a affordable housing fund, which right now, going in a recession, the demand for affordable housing is going like this. It is a need that needs to be filled. And in the markets that we're operating in the Midwest, we have 400 homes now, 3-bedroom, 2-bath, that have been accumulating over 2 years. And we have huge lists of people looking for affordable housing. They're not criminals. It has a bad rap. These are hardworking people that just simply don't make enough to live in these areas, and that the government will subsidize their rents. And so we're converting 2-bedroom rent-ready, 2-bedroom, 3-bedroom, 2-bath homes into affordable housing, which gives us hedging against delinquencies. They get in there, the government subsidizes, there's a delinquency, the government subsidizes that too. So it allows us to have consistent cash flow in a recession while serving a need in the economy. And with those single family homes, we can do 30-year fixed interest, which allows for us the ability to hedge rising interest rates. And so I'm kind of taking a different approach. Instead of saying like, let's find the distressed or opportunistic buys, let's serve the distressed need right now. And that's what we're working on.
Yeah, that's great. That's a great way to take advantage. Dave, what are some of your thoughts? Are you hearing about this as well? Or is there a way that you're kind of taking advantage of this currently?
Yeah, so I think in this type of environment, and I see it in several different asset classes. You know, I mean, one of the big things is, you know, 5-year rate locks expiring. You know, and I'm constantly talking to, you know, over the last 2 years, we've acquired around 30,000 acres, and I'm hearing it on that side. I'm hearing it on opportunities coming up in the near future, or it kind of happening already. I'm seeing it in self-storage, and we're seeing it as we're acquiring pieces of prime, small pieces of prime real estate for car washes. You know, there's opportunity in the market today that wasn't available 6, 8, 12 months ago. And I believe those opportunities will become stronger. And so, you know, Patrick talked about the opportunity where they were able to swoop in and take action and take out an asset, you know, that probably wouldn't have been possible 8 months ago, 12 months ago. So I think it's good to have cash or access to cash in this type of a market. I believe we're going to see opportunities in the next, you know, 2 months, 6 months, 8 months to 18 months that are great buying opportunities that, you know, would not be here if we wouldn't have some of this distress going on in the market. So I see it as a great time to be ready, be agile, have cash or have access to cash, and take opportunities or take advantage of the opportunities that present it. And when I'm talking about take advantage, I'm not talking about take advantage of people. I'm talking about there's going to be assets that come up for sale that you're going to be taking a problem off of somebody's hands. It's going to work very well for you and your investors.
That's absolutely right. Just being ready for the opportunity. I wanted to take some time now before we get into questions, just to really go into one asset class. Each of you kind of jump into one asset class. I know we've got a lot of different asset classes covered, and some, you know, we offer different types of things. Let's start with Dennis. I know you said that you have an income fund. Can you maybe, not necessarily to pitch what it is, but just, you know, talk about some of the pluses and minuses? Obviously there's risks to everything. So maybe you can just talk on, here's kind of what we're doing. This is kind of what we're expecting. And these are some of the risks. And then we'll kind of go around and I know Patrick's got the affordable living, and then Dave, you can choose from your whole handful of things that you're doing. You can choose one to kind of share on. So why don't we start with Dennis?
Sure. So our income fund is a multi-asset income fund. So our goal was to shield the potential negatives of one type of asset class. So for example, if you invest in apartment buildings, historically speaking, you usually get a year or two, I call like the drag years, right? Because the first year you have the closing costs that will kind of weigh in on the projections. You have the cost of the CapEx for the business plan. All of that kind of takes a hit on that cash flow in year 1 or 2. So what we decided to do is we wanted to have, you know, the apartment building syndications, but we also wanted to balance that out with some ATM exposure and some hard money loans. So what would happen is as the apartment building matures through their business plan, you get that offset of that higher income from those other cash flowing focused assets. So it's kind of like I was modeling our fund for something that I was looking at when I started investing. I started investing 20 years ago, and I always thought my portfolio should do two things. It should appreciate and cash flow. And that's kind of how I got into alternative investments, because I found that traditional assets appreciate really well. But when it came to actually creating cash flow, that's where I struggled. I went through the REITs, the MLPs, the closed-ended funds, all of that stuff. And it ended up the same thing. The volatility always crushed the yields. So that's where, when I was designing my multi-asset income fund, I really kept that in mind. So I wanted to balance it out. I wanted to have some appreciating assets balanced with some high cash flowing assets, and the combination would allow for us to pay a more consistent yield. So we pay a monthly return, but we're able to pay the same monthly return every single month because we have that balance in there.
That's great. I like that. Yeah, being able to balance out, some of the things that are more appreciation assets, and we get some cash flow in there as well. That's great. Patrick, talk to us a little bit about what you're doing with affordable housing and how that plays out for investors and risks involved and things like that.
Well, I kind of just went into the affordable housing a little bit in that last comment. Maybe I'll pivot to the energy.
Sure.
Yeah. So, moving along the same threads that Dennis was talking about, it's important to be, diversified. And I think that when I got to like 500 million co-GP in my portfolio, I started realizing most of my investors were not as diversified as I was. And then I started looking at other alternative investments. And so we pivoted into diversified energy funds. Now, natural gas and oil drilling tends to have a bad rap of losing investors' capital traditionally. And even today, people will put them in one well, maybe two wells. And if you runs dry or there's an operational challenge, they lose it all. And so how do you take advantage of ordinary income write-offs in energy? I mean, 75% of your investment comes off your W-2 income. How do you take advantage of that without losing it all? And so we applied some of the traditional multifamily or real estate concepts to energy. And so the only type one fund that's like it, where we're actually buying leases, not just a well assignment, putting it into the fund with known proven locations, like in real estate. We're drilling dozens of wells across multiple locations. So you get scale. Like if you have a lot of units in a multifamily deal, if one floods or there's a fire, it washes out in the economics. You also have economy of scale. You do that across dozens of wells in multiple states. You also get not only diversification in geography and diversification scale, you get diversification in geology. So now we can go for some natural gas and some oil, and we can pivot between the two. And like today, we're pivoting to oil because oil is a much stronger asset class, but we have drill sites within the fund to pivot back to natural gas. And we paused the natural gas well halfway when gas prices took a pause. So we're ready to fire that one back up. So the diversified energy fund provides for incredible tax advantages, a lower risk way to get into a completely non-correlated investment. We don't even have debt in the fund, and monthly passive income and an exit. And so that's probably my number one go-to right now if you're looking for that combination of outside of real estate, cash flow and appreciation.
That's great. There's some great tax benefits as well, and we'll get into in a minute here. Dave, let's talk. I know you have a whole like you're holding 7 cards in your hand. Which one do you want to talk about as far as alternative assets today that would benefit the conversation of the investors here?
Yeah, so really the funds that I have open is just a direct reflection of my own portfolio. And so we do a lot of self-storage. We're top 4 ATM operator in the space in the country. But I'll talk about car washes because we're super busy with car washes right now. We got 8 operational sites. We've got 7 more development sites, 7 more coming out of the ground, and we got a total of 72 lots under contract in some form of development, whether it's in the very front end of entitlement all the way up to opening in the next couple weeks. And so I'm excited about our car wash. I'm excited about the car wash space. I love it for a number of reasons, but it's number one, it's a very cash flow rich business. The operating margins are, you know, we've got operating margins in the 45 to 50% range. You know, you know, you and I were in Salt Lake City last week, and you know, multifamily heavy conference, and you know, I always sort of feel bad for some of the guys that were, you know, when their deal gets killed because of a 50 basis points or 75 basis point rate hike, and I'm just not smart enough to operate on margins that are that skinny, and so, you know, just having that operating margin, number one, it's a really good product. It's a great product. It's a cash flow machine. Many people don't realize this, but when you're talking a brick and mortar building, typically when you go out and you buy a self-storage facility or an apartment building, you got to do a cost seg study in order to accelerate your depreciation. In a car wash and a gas station, they're unique, and they're the only asset classes where the building, actually, you can depreciate it like it was a piece of equipment. So you can take the whole building and get 100% bonus depreciation. Well, in this year, it's 80% first year bonus depreciation on the entire building. You don't have to do a cost seg study. It's like it was a piece of equipment. So just very tax aggressive. We're building this portfolio to at some point sell. We've seen large portfolios of well-run tunnel washes, you know, 20 tunnel washes and up in a portfolio trading for 18 to 20 times EBITDA. And so, you know, being in this space, having the opportunity to run this business and hold the business and create an immense amount of cash flow and income for our investors, for ourselves, is great. But also being able to at some point exit and seeing those kinds of multiples, it's a fun asset class to be a part of.
Absolutely. That's really important. You know, there's a strategy that's called the private equity roll-up strategy, and it's something that's being utilized with car washes or dental practices or gas stations where, you know, if you have, you know, one or two of them, they sell for 8 or 10 times EBITDA or 8 or 10 times earnings. But if you have 50 or 30, or, you know, they'll sell for 20 times. And that's just a strategy. You sell them to private equity, and it's a real attractive strategy. So this webinar we're doing is a little different than the ones we normally do. There are going to be some opportunities presented. Nothing in this, you know, presentation is an offering for a specific investment. We're just introducing different types of things. And if you're interested, there are, you know, ways to connect with each individual. This will be recorded and sent out. Somebody's just asking about that. So I'm going to do that here. We're going to take a quick pause here. We're going to have some questions that are coming in. If you do have questions for anybody on the panel here, or all of us, stick it in the chat. There's a lot more to talk about, so we have a few more minutes to talk. I did want to share something that's coming up for us at Bronson Equity. We're super excited about it. It is a oil and gas technology fund. So it's very different than any sort of oil and gas deal that you'll see. It has to do with the way, the method that's used for oil and gas drilling. There's a new technology that we're around that we think will actually change the way that oil and gas is drilled for. This is not a steady Eddie cash flow type of deal. It's a very high potential, you know, 17x upside or higher if it goes the way we think it could go. With that comes a little more risk. I just wanted to share this with you and give people an opportunity to see it. So this is kind of what I love about it. It has, you know, high upside. There are some taxable benefits as well. And, you know, there's some cash flow that will come from it. It's in a very experienced team. This is going to be Monday night, or Monday at 4 p.m. Pacific. So similar time, but just, you know, next Monday. So, you know, a few days from now, just right around the corner. So I'm going to go ahead and stop sharing. I'm going to put the link in the chat here. If any of our panelists have things that they would like to share as well, they can feel free to share that. I've always believed that, hey, you know, if an investor invests somewhere, it's great to hear about deals that are unique. And so this is a deal that's very unique. And I know a lot of our panelists have unique deals as well. So I wanted to point that out. So we are getting a few questions here. Again, if you do have questions, please do stick them in the chat or in the question and answer section. We do have a question here from Miguel, wanted to touch base on this. He's saying, because of the situation on short-term rates and capital calls in multifamily passive investing, is there better protection for an investor to invest in a multifamily fund versus investing in a specific property? I have an opinion on that, but I'd love to hear from our panelists. What do you guys think? Is a multifamily fund better right now, or is a specific multifamily deal better? Or does it depend? I'll jump at once.
I could
Okay.
take that. So to answer that question, there's just a couple of quick pointers that I just want to highlight. So there's a couple of different funds out there. There's closed-ended funds and there's evergreen funds. Closed-ended funds have a specific time frame versus evergreen fund. Money can go flow in and out. So those are two important distinctions. And the second distinction is between a blind fund and a non-blind fund. It's basically when you're investing in the deal, can you see the actual assets inside the deal? So to answer that question, it's almost impossible to say that a fund is definitely better than a specific deal or vice versa, because let's say it's a blind fund, then you really are just investing in your relationship with the operator and the track record. So there are funds where you invest in, it's a multifamily fund, but if they turn around and their last 5 deals all had interest rate caps, then you probably would have been better off investing in with the one deal, with one specific deal that had fixed debt on it. So it's kind of hard, but if things are good in a good environment, you could probably be more well diversified and probably have better returns on averaged out on the funds versus the specific deals, because now you have that exposure to multiple apartment buildings versus that one. So it's really hard. It's really about preference. And if you are looking into a fund, don't just assume it's better. You got to ask the questions. You got to figure out if it's a closed-ended fund, if it's an evergreen fund, how many of the assets have been identified, what kind of debt is on those assets. And once you kind of get all of those answers, then you compare it to the specific deal that you are looking at. And that's kind of how you're going to make that determination.
Awesome. Thank you, Dennis. You are like an almanac. It's just inside of you. It just comes out, right? Awesome. Patrick, I know you got something there.
Well, so with the fund model, it can lower risk, because I think what the implication was, you put a bunch of risky assets potentially in one model, and maybe the sum of the parts is lower risk. I like to think funds, sometimes they help because you can be opportunistic in your acquisition and be quick. I like more the chance to quietly analyze, because I'm an engineer and by trade, and I will sit and analyze, and then I will acquire an investment. But if you're going to be buying opportunistic deals or deals that you find at a discount, they're going to go fast, and you're likely going to get a call from a broker or some kind of referral, and then you're going to have to get in there, underwrite it overnight, the very next day, show up on site. And I mean, I was doing some of that stuff flying from Oahu out to Houston in Florida, and Bronson was there on some of those trips.
You're crazy, man. Red-eye flights all the time. And I was like, I don't know how you're doing this.
When you find those, it can be and then now after you've done all this due diligence, if you then have to go raise capital for it, you can lose the opportunity. And so we've partnered with family offices to put up large amounts of money so that we can acquire it fast. Now, having a fund, a lot of liquidity in a fund helps you be much more agile, right? But Dennis is saying the challenge is that you don't have a lot of control over what they're going to buy. So you have to be very clear on the investment thesis of what the buy box looks like, and you got to really trust that sponsor. At the same time, I kind of prefer that investors get to invest based on the attributes of a specific deal, right? Because sometimes sponsors can be under a lot of pressure. They have this money, they're projecting a return, and every day it sits in the fund and it's not deployed, return's going down. And then you flip the script, you end up on the extreme end like a REIT with extraordinarily terrible returns. They have billions to deploy. They're just swooping up assets at top dollar all over the place, right? And they're under a lot of pressure to acquire. It's better, I think, to find the right operator and that will present a deal to you and raise the capital based on its own merits. Is that the right strategy right now? Well, it may mean that you don't be able to move as quickly to buy some of the new opportunistic assets. But that's the dilemma that I think that you find on the stand-up deal versus the fund model.
It's great, Patrick. Thanks. Dave, do you have any thoughts on this?
Yeah, so I'm not in multifamily, but I'm very familiar with running, self-storage funds. And, I would just tell you this, and I'll go with your answer, and that was it depends. I mean, it depends on what's in the fund, right? So, I mean, I'll give you an example. When we did the roll-up in our self-storage fund and sold 26 properties, there was about 20 of those properties were in the fund. I think it was 18 or 20 of those properties were in the fund, and then the rest were one-offs that we had done outside of the fund before we created the fund. And of those 6 or 8 properties that were outside the fund, we had a variation between one, the very worst one was 17% annualized, all in cash, you know, with the residue from sale and all that. So it's 17% annualized. The very best one was 66% annualized. So really what all you're doing when you invest in a fund, you're helping to mitigate that you know, that difference. You're hoping, you know that they're not all going to be 66%. You're hoping that not, you know, maybe you'll have a dog or two in the fund, hopefully not, but if you do, you know, you're spreading your risk across, you know, those 5, 10, 15, 20 properties in the fund. So that's really all you're doing is you're getting away from that sort of volatility and maybe picking the wrong one. You know, if you're not active and you don't pick the wrong one, pick the right one. We all want to be in that one that returns 66%. But if you know, if you want to kind of spread your risk and expose yourself a little bit less, go with the fund.
Yeah, absolutely. I think there's, like you said, depends. There's different sides to that coin. I've always, as an investor, generally preferred individual deals because you can analyze them a little more clearly of what is this deal. And then maybe get 4 or 5 or we get a number of these together. But if you have if the fund is too large, it can be hard to analyze. But if it's a great operator, it shouldn't really matter technically. But I mean, again, there's pluses and minuses. There's a lot of considerations that go into that. And I think it just depends on preference. I think there's a lot there. Another question coming up, has anybody investigated medical office property? And I don't know if this is talking about specifically medical practices or like a triple net using medical properties. Anybody looked into this at all? Or even owning, I guess, more retail or office space related to that? I guess triple net is what they're asking, double net. Okay.
That is not in my asset class bucket, not meaning it couldn't be a good opportunity, but I do not.
Yeah, absolutely. Yeah, some people love triple net because it provides, consistent cash flow. There's long-term contracts. A lot of people that really want to be passive, that's a great way people can, get a lower return with less, supposed risk under a Walgreens or a Starbucks or something like that. So I think that's good. Any other questions? I'm not really seeing many more questions come in here. So I guess you guys are that genius. I guess see one more question here. So if anybody has anything they want to ask, either to stump the experts or to just ask questions. There was a question, looks like Patrick asked this. Let's talk for a minute about taxable benefits. I know one of the things that comes up a lot is that, obviously this is not tax advice to anyone, but there are certain investments such as energy investments, oil and gas, or things related to oil and gas that actually can provide, in some circumstances, ordinary income reduction. If somebody, some deals allow for someone to become a general partner. Obviously we're not pointing out any specific investments or things like that, but is this something like, how do people weigh that out? And again, if somebody is a W-2 earner or a high S quadrant, meaning they're self-employed, what are some strategies using this or other means to be able to reduce their taxable basis?
Yeah, I'm sure Patrick will have something to say here, but I'll chime in as well. When you go to mitigate or if you want to live the tax efficient life, you got to get creative. You got to find it. As simple as having a couple different streams of income. You got your ordinary income, you got your passive income, and then you may have some capital gains, which can be ordinary or passive. But really, your job as a shrewd investor, if you want to live the tax efficient life, you gotta match up asset classes that will fix your tax problem with that specific stream of income. For me, if I want tax relief against ordinary income, I've invested heavily in the natural gas space over the last couple of years. Been investing with a specific family for going on 5 years now, and we've had a natural gas fund for the last 2 years straight, and expect to open one here in the next couple of weeks. So personally, I use natural gas and help knock down the tax liability on ordinary income, and it's worked very well.
Great. Thanks, Patrick.
Yeah, sure. And I think what Dave Zook's pointing out is that energy is far more tax advantage than real estate. So the challenge with real estate is that we get a bunch of depreciation. And that's typically 27.5 year straight line, unless you do something cool. We can do like in large portfolio, single family or multifamily, we can do cost segregation and pull that up, and then even bonus depreciation. And what does that mean? That means now you're like, you invest 100,000 and maybe you're at 50 to 60,000 in the first year on your partnership return paper loss, right? And the challenge with real estate though is that paper loss, that only offsets passive income for these larger syndication investments. But you're active in your day job, you're probably earning a lot, probably a lawyer or a doctor or high income earner like I was. And you're like, well, I'm still paying it. I mean, the doctors that call me that are 600 to 800, 900 a year, they're paying 45% tax brackets. And no matter how much real estate they invest in, they can't offset that tax obligation. But what energy lets, what Dave Zook's pointing out there, it'll let you actually take those income. And they don't, in the first year, we don't call it depreciation, we call it intangible drilling costs. And the difference is that K1, it has paper losses on it, phantom losses. I mean, you made income that year, but it's phantom. And those will actually roll through to reduce your ordinary income, reduce your taxes and offset your ordinary income, your W-2 income, K1, 1099, all that stuff. And so, yeah, I mean, it's the energy fund. I see the question here is the energy fund allow for that? And it does. You know, we project about 75% of your investment in the first year. Last year, it was actually 86% of their investment was offset of the ordinary. Invest 100 grand and 86% of the 86 grand last year came off your ordinary income. So you get taxed on 86 grand. You know, if you're in a 40% tax bracket, that's like saving $33,000, $34,000, $35,000 just in taxes. It's a massive return just for investing. And so that does help tremendously. And if you can get into an asset class which allows for a de-risking approach, because there's a reason it's tax advantage. Let's be real. There's a greater risk profile in investing in oil and gas drilling than there is in an annuity. So you're taking a little bit of the risk profile. You're getting tax advantage, cash flow appreciation, and diversification. And as long as you can find the right operator, like Dave's talking about, you maybe do it in the right kind of fund, like our funds, then you can do it in a lower risk way and invest like the wealthy and not pay tax.
Right. That's great. Thank you. Thank you guys for answering that. We got a couple more questions. I want to move a little quicker. I want to get back to Dennis here in just a second. Somebody's asking, PS is asking about never invested in private equity deals before, currently file our own taxes without the need of a CPA or accountant. Can you comment with regards to the tax filings or complexity? Do you need a CPA? I would say this real quick. I'm just going to answer this one. I would say you should 100% get a CPA to do your own taxes, because they will find things that you probably, unless you're a CPA and you're keeping up on all the stuff, that you will not find. So I would even if you're not investing in these passive deals, I would say do it. And I'd say if you are, you definitely need one. So I would say definitely do it. This is a question we're going to go around. This is going to be our last question. I want to try to see if we can maybe take about a 1-minute answer for each of you. So we'll start with Dennis. Are there particular sectors or categories you like best right now for alternatives that tend to be shorter duration? So kind of like 2 to 4 years. So let's start with Dennis. Anything shorter duration that you like?
I would definitely put hard money loans, even though that's kind of difficult because you need to build up a roster or at least partner with someone that has the roster of flips. Just because I'm a big fan right now of investing in higher cash flow that's actually collateralized by a hard asset. I think this is the time to do it. The rates have gone up. You know, we see anywhere between 10 to 15%, and we're actually going to be increasing our distributions because of that, because we're more gearing towards that. So definitely hard money loans right now. I think there's a great environment for that.
Awesome. Thank you. Hard money loans. Awesome. Dave Zook, what are you like for the kind of that mid-range 2 to 4 years? What alternatives do you like?
So we project our self-storage deals, we project a six year hold. But when you look at our history, we've been, buying from a mom and pop, selling to a REIT in that 3.5 year range. So that would fit in the 2 to 4 year range. When you're thinking ATMs, you're thinking about a 7-year deal. But when you consider the first year, when you consider the cash flow, and then you consider that you're getting the tax benefit, the 80% bonus depreciation. When you consider the first 12 months when your cash flow starts, you're getting 60 to 70% of your cash back in year one. So you get 60 to 70% of your principal back in your pocket in year one. So it's a couple different ways to look at it. And then you got a 6-year cash flow stream behind it. So I'd probably go with those two.
Yeah, that's great. I love ATMs for that reason as well. Patrick, what about you?
Well, the hard money loan one, certainly with rising interest rates, definitely a little bit harder to get debt. I think that's a solid one that Dennis brought up. And I'll probably pivot the same way that David took, even though we're very conservative on our projections, and we always say something that the last energy exit was a under 3-year exit, but we're saying 3 to 5 years. And right now, where energy is, Goldman just got on saying was the best hedge against inflation, and we're seeing great signs in the global demand with OPEC and Russia dialing back, and I think that that's a really good play. In the affordable housing space right now, with affordable housing needs skyrocketing, with the ability to hedge against interest rates and with the ability to get rents that are subsidized, we're not so worried about delinquencies, and we can still get 3%. That's a really solid play. I mean, that's a play right now in the short term that will provide for an incredible demand and a solid cash flow. And so that plays similar, like 3 to 5 year play. But the point to Dave's point is, we always tack a couple of years on the end to be conservative. But those are probably the 3 I'd mention.
Yeah, for me, I'm a real asset guy. I love the energy space. I love the ATMs. I think also something that has not been mentioned is physical precious metals. I think there's a great case right now in a time of inflation. Now, metals don't produce cash flow, but they do store value very well. So instead of sitting in cash, you can buy precious metals, and then you actually borrow against the value of your precious metals if they're stored at a third-party vault. So that's an interesting strategy. Well, gentlemen, really appreciate you coming on today. If you can put your info in the chat there, and then I'm going to have you go around to say if you have anything you're working on. You mentioned some of the deals. Wanted to share our next event we're going to have is going to be April 12th at 4 p.m. So 4 p.m. Pacific. I'm just going to put this in the chat. And it's going to be an event on inflation. We have 2 speakers confirmed so far. We've got Mark Moss, which has about 500,000 subscribers on YouTube. If you don't know Mark Moss, brilliant guy when it comes to economics. We also got Jay Martin, who runs the Vancouver Resource Investing Conference, a lot in the mining space. And then we're working on a couple of other big name folks. So really, really happy that everybody can join us. Can we just take maybe 20 seconds from each person, how people can reach out to you, and then we'll go ahead and wrap up.
So my website, our website is therealassetinvestor.com, and the best way to reach me is tap into my team. I got a great young team, and they will respond. info@therealassetinvestor.com. Love to help.
Awesome. Thanks, Dave. All right, Patrick.
Invest on Main Street, invest on Main and then Street, all spelled out.com. That's our website. We have a couple investments at the top. We're launching the Affordable Housing Fund in the next month. We have a free download of the Passive Investor Guide, and I dropped a link in the chat to get a free copy of my signed book. I actually have hair in that book even, so it wasn't that long ago.
I don't think that's you. I don't think that's you, man.
I know Bronson is the reason why I lost all that hair. Anyways, we'll send you an Amazon #1 bestseller, a free signed hard copy of that. Love the stories, persistence, pivots, and game changers. investonmainstreet.com/book, and I put that in the chat.
Awesome. I love the haircut. Awesome. Dennis, how can people get in touch with you?
Best place is my website, sihcapitalgroup.com. You go in, if you sign up, we have an ebook, which is a abridged version of my book, The Alternative Investment Almanac, where I interview Thanks, Patrick. That's my book. We don't do a lot of deals. We're not a quantity type shop. We really only do a few deals every year. So if you want to connect, I love having relationships with my investors. So reach out to me directly. I posted my contact info, but it's Denis, D-E-N-I-S. I only have one N in my first name at sihcapitalgroup.com.
Awesome. Well, I just want to thank each of you, each of the panelists for being here, as well as the attendees. Really you could be doing a lot of things tonight and spending time doing this or watching this on a replay, but you chose to do this. And I think it's really important that we continue to pay attention, because this is like a game. It's like a board game where the rules are continually changing, right? The pieces are moving. And if you're not watching what's happening, you'll miss out on opportunities and you'll lose money, you'll lose opportunities. So just really want to say thank you to everybody for being here. Again, we're committed to helping try to provide a place of valuable education. I see a hand floating up the screen there. I'm not sure what that is. That's kind of cool. Anyway, some animation there. Anyway, thank you, everybody. Really appreciate it. Everybody have a wonderful night. We look forward to seeing everybody on April 12th or at our oil and gas tech deal coming up here in the near future. Thanks, guys.
Thanks, Bronson. Thanks, guys.
Bronson,
Guys.
Dave,
Okay.
Dennis.
Thanks.
Have a great night, guys.
Bye.